Welcome to ValueBridge.net, your paint-by-numbers resource for value creation in private equity deals, funds, GPs, and investment programs. This video shows you how to use the Microsoft Excel templates that are available for almost every topic on the platform. You want to start by finding the template that best matches your situation, so click over to the module page where you can browse by the different topics. Let's say that we select multiple expansion because we want to separate the value driven by broader market forces versus the GP buying below market, selling to strategics at a premium, or materially improving the quality of a portfolio company's revenue and earnings. Here we click on Module 13, Market Multiple Expansion and Intrinsic Multiple Expansion. Scroll down below the video and click the button for the Excel template. The first thing to note is that most of these templates have two tabs, one for a buyout that has leverage and an EBITDA-based valuation, and another for a growth deal with a revenue-based valuation. The math on the two tabs are different. For example, on the revenue tab, we don't have inputs for TTM EBITDA or gross profit, and we don't have some of the value drivers that we see here, like EBITDA growth, EBITDA margin expansion, gross margin expansion, or operating margin reduction. They don't exist when you have a revenue multiple. Now, you don't necessarily have to use revenue, gross profit, and EBITDA here either. If it's a finance company, the top line might be total interest income, gross profit might be the interest income after reserves for bad debt and the cost of capital, and EBITDA might be the pre-tax profit. Just make sure that those changes to the labels go everywhere else on the sheet. The main thing is that you use this EBITDA valuation tab if the company is valued from somewhere in the middle of the income statement, but use the revenue valuation tab if the company is valued from the top line of the income statement. The next point is that we should only change the numbers highlighted in yellow. These are the independent variables, the value creation inputs. Everything else is a dependent variable that's driven by a formula, and we should almost never touch them. So notice that we don't plug in the valuation multiple, which is just TEV over R. And we don't plug in the enterprise valuation or purchase price, which is TECV plus ND. And we don't estimate the total equity from the fund's investment and the ownership percentage. Rather, the ownership percentage comes from FECV and TECV. You can learn more about why we do this in Module 6, but it goes a long way towards making sure that your spreadsheet doesn't break when you update the numbers every quarter. And it becomes even more important when you start bringing holding period events like follow-on equity investments, dividend recapitalizations, and add-on acquisitions into the models. All the value drivers are calculated over here on the right. In the derivative model, they're first calculated in units of absolute dollars of value creation, and then they can be converted to times money value creation, relative value creation, equity return multipliers, and value creation IRRs. In the logarithmic model, the value drivers are first calculated as equity return multipliers and then converted into the other four value creation measurements. You'll see that despite the underlying math of the two models being quite different, their results are nearly identical, usually within 1% or 2. And then down here we finally get to the chart. By default, it pulls from absolute value creation in the derivative model, but you can change that by pointing these cells in column C to other value drivers on the sheet. Now, this chart probably gives you more value drivers than you want, but instead of deleting them, it's best to just hide the rows that you don't need. You could do this with a mouse like this. Or if you're an Excel jock, you can highlight with Shift Space and hide with Ctrl+9 as follows. To bring everything back, you can highlight and press Ctrl+Shift+9. Okay, I mentioned follow-on equity investments and add-on acquisitions earlier. Several of the modules and Excel templates are specifically designed to address those activities. For example, here's the Excel template for Module 35. This one includes a support equity investment, an add-on acquisition, a debt-funded asset purchase, an equity distribution, and a dividend recapitalization. However, despite all these inflows and outflows, the value creation math is identical to what we see on the template for Module 13. The The difference is that we just need to pre-format the highlighted numbers here in the entry and exit columns to make sure that they account for all the things that have happened after the initial investment was made and before it was finally exited. So that is how the ValueBridge.net Excel templates work. I hope that you found this overview helpful. If you have any questions, feel free to get in touch with me on the support page or email me at mike@valuebridge.net.